Hi all, welcome to this new episode of my podcast, A Digital Tomorrow. Today I'm joined by Professor Douglas Arner. Douglas Arner is the Kerry Holdings Professor in Law at the University of Hong Kong and an expert on financial regulation, particularly the intersection between law, finance and technology. He's a very well-known professor and for example, just to give you an idea, he's among the top 250 authors in the world by total downloads. So Douglas, welcome to my episode, to my show.
Many thanks, Royal. Great to be here.
Well, it's my pleasure. First of all, before digging deeper into the topics that we want to discuss, I think we should start with your personal journey. So if you could briefly tell me a bit more about your personal journey. For example, what made you decide to enter this world of fintech?
Yeah, thanks for that. It's something that I've been working in this area for a long time now, and I've always had a strong interest in the interaction between finance and development and technology. You know, some of the first projects I worked on back in the 1990s actually involved electronic payment systems in a number of countries in Africa. And I think it's really interesting as we look at the role of finance in sort of broader sustainable development. The finance is interesting because it has both positive externalities. In other words, finance has benefits not just for the people involved, but from the standpoint of supporting wider economic participation and development more generally. So it has positive externalities. So it's something that you need finance, you want finance. We need to figure out ways to support it. But at the same time, finance has negative externalities. In other words, finance is subject to periodic crises. And if anything, crises are a feature of a market-based financial system, that we have crises every 10 years or so. And this is something that we need to keep in mind. And as a result, when we're thinking about finance, it's something that has both positive benefits as well as risks. And very often, there's a strong interrelationship between finance and technology. It's something that, if we look back over the past 10,000 years of human history, we can see that money, finance, technology are basically co-developmental. Think about money, for instance, money evolving from stone discs in early settled civilizations about 10,000 years ago, metal coins with the advent of states and metallurgy. We can see emerging paper money for the first time in China about 10,000 years ago. About 700 years ago, the emergence of bills of exchange, letters of credit, of checks. We can see at the end of the 19th century, the emergence of the telegraph. And one of the first messages that gets sent across a telegraph is a payment instruction. We can think about the 20th century, a process of electronification across the first half of the century, and digitization really from the 1960s, the ATM in 1967, the rise of SWIFT in the early 1970s. We can think about real-time gross settlement systems across the 80s, 1990s, mobile payment systems, M-Pesa in Kenya in 2007, Alipay and WeChat Pay in the context of China. In parallel, the emergence of Bitcoin and cryptocurrencies in the aftermath of the 2008 global financial crisis, finally emerging as fast payment systems, stable coins, and central bank digital currencies in the past couple of years. And that's 10,000 years of the evolution of money and technology. And what we see throughout all of those periods is this interactions between the positive aspects and the risks. And it's really these things that have drawn me over the past 25 years to focus on this interaction between finance, technology, and regulation.
Mm-hmm. Well, thank you very much for sharing your journey with all of my listeners. And well, I think now it's time to talk about what's happening. So let me rephrase this. As you know, we are living turbulent times. I mean, we've been through a pandemic, which is not over yet. I mean, it's improved in many ways, but the pandemic is still there to some extent. And then, as you know, well, now we're going through some conflict. So I'm not going to talk about politics or geopolitics, but of course, everything that happens either in the area of pandemics, wars, has an effect on finance, on the present and future of finance. So this is why I wanted to ask you, like, from the point of your areas of expertise, law, finance, technology, what's happening now, and more importantly, what will happen next? What's going to come after this whole mess that we are going through right now?
Yeah, thanks for that, Oil. And I think that's exactly right. It's very useful to think about sort of your bigger picture trends and processes, and then try to use that to gain a better understanding of what is happening around you and also what you might see going forward. And I think if we think about the decade of the 2010s, the last decade, I think we can say that global finance was really fundamentally driven by three big developments, three big themes. The first of those was crisis, in particular the 2008 global financial crisis. And if we think about global finance across the last decade, many aspects were really driven by the experiences of that crisis, its aftermath, and the responses to that crisis. The second, which was very much one of the core responses to that crisis, is regulation. And it's something that in the aftermath of every crisis, there is an attempt to build regulatory systems to prevent a repeat of that crisis. And that's a process of learning of human civilization. But if we think of the 2008 crisis, it was a big crisis, and it led to an absolute explosion in numbers, scope, depth of regulation all across the world. And that fundamentally has transformed finance. And the third was really technology. I mentioned these sorts of big picture technological trends, but if we think about the decade of the 2010s, the last decade, technology in finance was really about the application of a range of new technologies to finance. You can think about cloud, you can think about blockchain, you can think about big data analytics, artificial intelligence, etc. And this was the idea of basically taking a range of new technologies, applying it to finance, and we see not only a range of new business models, but we see a range of new entrants, especially the whole fintech movement and the creation of a whole range of new startups coming from different directions and applying new technologies to do finance in a different way. And really, those three factors meant that by the end of the 2010s, the global financial system, and the financial system in particular in developing countries such as China and India, fundamentally looked different than it had 10 years before, an absolute transformation. And I think as we look at the 2020s, I think that it's really three big themes that are driving finance across the 2020s. The first is technology. But when we think about technology in the 2020s, I think we're thinking about technology in a very different way than we were previously. In other words, technology today is absolutely transformative. Think about something like a central bank digital currency or a global stablecoin. If had Facebook's proposal for Libra actually launched as a digital currency usable by billions of people all across the world, that's not just new technology changing finance. That would have been a major transformation of the way that every aspect of money and finance worked. That's a different scope and scale of technology. Similarly, if we think about Ant Financial in China, had the IPO gone ahead, had that sort of networked platform model gone ahead, Ant was in the process of absolutely dominating not just finance, but data across the Chinese economy and potentially much more broadly. That is absolutely transformative. And of course, if we think about the impact of COVID on digitization, that COVID-driven digitization has dramatically accelerated all of these trends, which we encapsulate as the fourth industrial revolution, to an entirely new scope and scale. So we're thinking about technology in the 2020s, we're thinking about much more transformative, much bigger scope and scale. Second, I think at the beginning of the 2020s, it was clear that sustainable development was going to be a major theme. There was already increasing focus on climate change. There was, in particular, if we think about the UN Sustainable Development Goals, the 2030 target meant that it was going to be a major focus. But I think the 2 years of the COVID pandemic has fundamentally refocused thinking of policymakers as well as people all across the world. Because as a pandemic, as a health crisis, COVID is fundamentally a sustainability crisis. And as a result, we've seen this new focus and attention. And if we think of this from the standpoint of finance, one of the biggest impacts of COVID from the standpoint of finance has not just been digitization, but the realization of how important digital finance is in providing resilience to sustainability crises going forward. And I think the situation, both with COVID as well as with Ukraine, and also the context of climate change and increasing climate disasters, is something that is only going to accelerate this focus on sustainability across the 2020s. And the third really big trend is an ongoing tension between globalization and fragmentation. We could really see this in the aftermath of the 2008 crisis, in particular with Brexit, the election of Donald Trump. But I think the global response and the politicization of that to COVID-19 has really driven these forces of fragmentation versus globalization to a new level. And of course, if we look at Ukraine, this is definitely one of the biggest potential impacts, is from the standpoint of fragmenting the global economy, the global financial system. And so I think as we look at the 2020s, our third big theme is this idea of tensions between globalization and fragmentation. And I think as we think in these sort of big picture terms, we can then look at each of the pieces, and often those are just one aspect of an ongoing process.
Well, you mentioned like many interesting ideas about which we could like talk for long. There is one in particular about which I would like to talk now, and it's that idea that you just mentioned now about fragmentation versus globalization. It's true that we can see this tension right now. This tension is there. It's actually very active. So I wanted to ask you, do you think that we are going towards a much more fragmented world? I mean, in other words, for example, do you think that the global economy is going to de-dollarize? Because we are seeing, for example, the rise of CBDCs, and I know that CBDCs are not designed necessarily for that, but well, I mean, some people say, and I mean, they might be true, that, for example, a strong digital yuan might help the yuan become a more internationally used currency in international trade. So I wanted to ask you whether you think we are moving towards this much more fragmented world.
Yeah, I think that there are a number of interesting pieces there. And the first is really around this idea of central bank digital currencies. It's something that over the past really 2 years, there has been an explosion of interest in central bank digital currencies. And I think we can think of this, one aspect is the evolution of distributed ledger technology, and the fact that central banks are always looking at how they can use new technologies to build better money and payment systems. It's probably the area of technology that central banks know the best, is payments technology. So central banks, including the People's Bank of China, have been following blockchain and distributed ledger technology for an extended period. I think the second factor that really drove it was that announcement by Facebook in 2019 of its plan to create its own private digital currency. And I think this is something that if we look at Bitcoin, at least for major economies and major currencies, has so far not emerged really as a real competitor, alternative, or threat. But something like Libra was seen immediately by major economies as something that was very much a real potential threat, a real potential alternative. And so you see a very strong reaction, both from the regulatory side, as well as logically from building systems. We see the People's Bank of China in the months after Facebook's announcement, announcing that it is going to be rolling out national pilots of its system, then called the Digital Currency Electronic Payment System, now generally known as the ECNY. And then, of course, COVID and its digitization and the essential role that electronic payments have played in both lockdowns as well as in government responses to the crisis has really driven forward efforts all across the world from the standpoint of looking at central bank digital currencies. And so I think when we think about CBDCs, it's important to keep in mind that sort of background as we think about the situation with Ukraine right now. The second aspect that I think is really important to focus on is that over the past 2 decades in particular, we have seen the evolution of an increasingly multipolar world. We can think about the economies of the US, the EU, China, increasingly of similar sizes. And I think there's a question about dynamics going forward. But from my standpoint, I think we're likely to be in a world where for much of this century, there is an approximate equivalence in economic size between those major powers, perhaps with India joining as a fourth by the middle of the century. And what that highlights is that from the standpoint of the global economy as well as the global political system, that we are increasingly in a multipolar world, and that there is no single player that is able to dominate that. And that is at the heart of some of these geopolitical tensions that we've been talking about. And one aspect of this clearly goes to monetary arrangements. And if we look at history, we can say that almost throughout human history, there has generally been a small number, one or a small number of monetary instruments which dominate cross-border transactions. It's simple efficiency. It's just easier if you're doing cross-border transactions if you have a common denominator, whether that is Roman coins, Chinese coins, Spanish coins, the sort of silver dollar that dominated all of Asia for several hundred years, gold and sterling, or the US dollar. That's simple convenience. It's just easier to have a small number of currencies where people can easily think on a cross-border basis. So having a single currency that is most widely used is both a reflection of convenience, but also there's the expression of that from the standpoint of geopolitics. And as we emerge into a more multipolar world, we can expect those major economies will be prefer to deal increasingly in their own currencies. I think at best, you're likely to see a situation where there are 2, 3 major currencies that people frequently engage across. Now, where technology really enters into this, I think, is from 2 different directions. The first is that technology makes it easier to deal with cross-currency arrangements. In other words, the advent of technology means that if we build systems that make it easier to do cross-currency transactions, we can think across more currencies. And so that provides a framework where we could see perhaps unusually a larger number of domestic currencies in use internationally. The second really focuses on that dynamic you mentioned around Ukraine. And there has been, particularly over the past 20 years, but really in the entire Bretton Woods period from the end of the Second World War, of the way in which the US has at various times used the dominance of the US dollar to basically enforce US political ends. And I think we've seen this accelerate over the past 20 years. And so it has been a sort of rising issue. And as you see the rise of multipolar major players, there is often a situation where there is less and less comfort with this. And I think when we look at Ukraine, this is something where there is this tension between the efficiency of using a system versus the sort of different geopolitical views versus perhaps the fact that new technologies might make it easier to actually move away from the traditional efficiencies in a largely dominant unit. So where all of that goes is to say that, yes, absolutely, we could see a situation where the conflict in Ukraine and the very active use, particularly of electronic payments and finance from the standpoint of a large number of governments, it has to be said, could accelerate movements towards a more multipolar monetary and payment system.
Well, talking about now about multipolar and fragmentation, there is one area though, which is, I think, as globalized as it can be, and that area is cryptocurrencies. Of course, not every country regulates cryptocurrencies in the same way. I mean, whereas some countries like China have adopted a much more tougher stance towards this new idea, the idea of cryptocurrencies, then some other countries are being much more flexible. So I know it depends on each country, but generally speaking, they are becoming quite mainstream and global, to the point that, for example, very recently, the US seems to have become even much more friendly than before. So I wanted to ask you, what role do you think that cryptocurrencies will play in the future of finance, and how do we make sure that cryptocurrencies, do not mess a country's financial stability goals?
Yeah, no, I think this is a really interesting question. I think it's also interesting that in some ways, if we look at cryptocurrencies, they're no longer really new. Bitcoin white paper comes out in 2008 in the aftermath of the 2008 financial crisis, in the midst of the 2008 financial crisis. Launches in 2009, that's 13 years ago. So when we think about it, this is no longer something that is sort of brand new. And it's had quite a period to evolve. And I think it's interesting from a number of angles. First is, if we think about the evolution, that Bitcoin in particular, its original rationale was as a direct alternative, a direct competitor to fiat monetary systems, a view that governments and government-issued monies had fundamentally been a failure, and what we needed was a technological alternative that worked better. And I think if we look at cryptocurrencies, that is still one aspect. But it's also been interesting that we see emerging around 2013, 2014, the first stable coins. We talked about Libra, but we see the evolution of other stablecoins starting. And basically the idea of a stablecoin is you are linking a cryptocurrency to a fiat currency, which of course is antithetical to the original idea of Bitcoin, but from the standpoint of many participants who want to be able to link cryptocurrencies to fiat currencies and the traditional financial system, they've played a very big and important role. And it's always been my view that from the standpoint of cryptocurrencies, digital assets more generally, that in order for the market to really succeed, eventually it needs to be integrated with the traditional financial system. And for that to happen, eventually it has to be largely subject to the same sorts of regulations from a financial stability standpoint, from a market integrity standpoint, from a consumer and investor protection standpoint. And I think what we've seen has been a sort of battle over the past 10 years where in some jurisdictions, regulators have largely left it alone. In others, such as China, they've taken a very strong, and in fact, China's approach started out a little hands-off, but over time has gotten more and more severe from the standpoint of trying to repress, eliminate, and even eventually with the central bank digital currency, provide a government-based alternative to digital currencies for use in the context of blockchain-based systems. So one of my views was that actually 2021, we're going to be a period whereby we are going to see a sort of normalization of cryptocurrencies and digital assets in most of the world's markets, where they would be brought into the traditional regulatory system. And I think that started to happen with the FATF's VASP rules. It started to happen with the EU's markets in crypto assets regulation proposal. But then 2021 saw a very high level of expansion and volatility in cryptocurrency and digital asset markets. In fact, digital finance much more broadly experienced a tremendous growth, popularization, and volatility. And as a result of those experiences, I think that regulators across the world have decided that it really is necessary to regulate cryptocurrencies and digital assets along the same lines as finance. Some, like China, taking a very restrictive approach, but everyone building some sort of system. Most recently, we see just the second week of March of 2022, the US president signing in an executive order to basically build a comprehensive regulatory scheme. So it's something that is happening everywhere, but there's a careful balancing because regulators don't want to trigger the crisis they're trying to prevent. So they're going in carefully, but with the full objective of bringing digital assets into the normal, regular financial system. And from my standpoint, I think that this, over time, is likely to support the greatest benefits from the use of digital assets more broadly.
And well, I mean, you mentioned now the idea of regulations, and you are an expert on regulations and reg tech. So I wanted to ask you, like, in general, why are regulations necessary? And I'm not just talking about cryptocurrencies. I mean, I can talk about cryptos like we were talking now. I can be referring to, I don't know, digital sandboxes, artificial intelligence. In general, when it comes to finance, technology, why do we need regulations? Because I know that some people actually claim the opposite. Some people say that regulations are kind of a hassle. But I mean, I think we need them. So why?
Yeah, I mentioned that idea of history and the role of crises and regulation. And if we think about market-based finance, the classic idea is it's the best system, it's the worst system, but it's the best one we've come up with so far. And it seems that crises are a fundamental aspect of market-based finance. And so if we're going to have crises, if this is a sort of negative externality, but finance has positive externalities, it makes sense to build systems which try to reduce the likelihood of crises happening, and when they do happen, to make them less severe. And this is really our first aspect of financial regulation. It's what you would call financial stability. It's about preventing crises. And one only needs to think about the history of financial crises to realize that they happen over and over again. And one only needs to think about how bad 2020 and 2021 would have been if we had a collapse of the financial system at the same time that our health systems and our economies were collapsing. And one of the reasons that didn't happen was all of those efforts to put in place more capital requirements, more liquidity, more supervision, better financial infrastructure in the aftermath of the 2008 financial crisis. So that's the first, is really because finance is subject to crises, and crises are something that we don't like to see. The second really has to do with the idea that we want markets to function. And if you think about it, at the heart of much of regulation is actually making markets function better. Think about something like disclosure. We have disclosure to make it easier for people to easily compare different financial instruments and different financial products. Imagine that you're trying to invest in something and you have two companies in two countries that have completely different accounting systems. It makes it almost impossible to understand what you're looking at and the differences. And this is something that if we think of something like sustainability and ESG taxonomies, one of our real risks is that everyone makes up their own way of looking at ESG, and you end up with fragmentation. So one of the key reasons for regulation is actually to make markets work better, to have standardized approaches to make data more easily comparable, which enables markets to function better. Our third is really around the fact that, in the classic statement attributed to a famous American bank robber in the 1930s called John Dillinger, "Why do you rob banks?" And his reply, "That's where the money is." And so when we're talking about finance, that's where the money is. And so they are a magnet for criminals and fraudsters. And as a result, if you want to get people to put their money into markets, they have to trust those markets. That's to get that positive externality. And so you need someone who basically goes out and polices fraud, theft, misconduct. And if we look at financial regulation, some of the earliest aspects are about preventing fraud and theft, which makes people happy, but it also encourages to put their money in. And the last one is really the idea of market integrity. Market integrity is the idea that you don't want criminals and terrorists to be able to use the financial system to basically clean up their money. And so when we think about AML regulation, we think about KYC systems, they're not there to add an expense for the financial industry. They're there to reduce the criminal and terrorist use of the financial system. And this is something that if we think about these objectives, they're very valid reasons why we regulate finance. And at the end of the day, all of this is about supporting wider sustainable development because we want the financial system to have the positive externalities and reduce the negative externalities. We want finance to make the world a better place and not make it a worse place.
Mm-hmm. No, indeed. I mean, I guess though that from the standpoint of a regulator or central banker, I may be wrong, but I guess it must be much more difficult now compared to a few years ago, because when, for example, the global financial crisis took place in 2008 and next years, well, it feels like it was all quite different from now, because now a central bank, a regulator, doesn't only need to regulate what they used to regulate before, but on top of that, they got all these new areas that we mentioned now. I mean, there are cryptocurrencies, there are other blockchain-related products. I mean, the world is much more digital, no? I mean, which is, it's amazing, it's great, but at the same time, I guess it makes their job a little bit more difficult than before.
No doubt. And that's absolutely 100%. And if you think about the world of financial regulation prior to the 2008 financial crisis, it was, as you say, a lot simpler. Everyone had kind of a common agreed framework for understanding what you were doing. You were thinking about market failures. You were thinking about correcting market failures from the standpoint of regulation. You were thinking about efficient markets. And you were thinking about sort of a paradigm of rational behavior amongst market participants. And 2008 really fundamentally changed that. And honestly, there hasn't been a sort of replacement from the standpoint of a common consensus about why we do things, other than that framework that I just highlighted of these regulatory objectives. The second, as you mentioned, is very much the technologies. And this is something that, technological change over the past decade has just been incredible. And from the standpoint of central bankers and regulators, this has made their lives a lot more complicated. From my standpoint, though, it's made life a lot more interesting. We have all of these new things to look at. And there are bad things about it, but there are also some very, very good things about it. And I think finally, the last bit is exactly the point that you make, that prior to 2008, the global financial services industry was a pretty homogeneous industry. And in the aftermath, with the involvement of all of these fintechs, tech fins, new entrants, new technologies, lots of people who were not coming from sort of that same homogeneous background. And that's made it much more difficult from the standpoint of central bankers and regulators to deal with the population that they're trying to work with. And so, 100%. I think it's gotten a lot more complicated. But from my standpoint, that is actually one of the wonderful things about finance. There's always something new happening, and that keeps it interesting. The downside is they often result in crises. So you're often looking at something from one side on the way up, and you're often looking at it from the other on the way back down.
No, I mean, I fully agree with you. I think that from the standpoint of a regulator, it must be much more difficult now, but at least from my own standpoint right now, I feel like it's much more fascinating than before. No, I mean, having so many different concepts, ideas, products, as you said before. I mean, fintech, techfin, and anything related to that. I think it makes the world much more interesting, albeit risky in some ways. No, because I mean, we're talking in some cases about new areas that, I mean, we don't know exactly how they're going to work out. Like, for example, I don't know, like those BNPL, buy now, pay later companies. I think that's an interesting concept, but there are many downsides to it now. So I think, I mean, it makes the whole payments area fascinating to see these new products, but at the same time, I think it raises many, I'm not going to say threats, but maybe questions.
Absolutely. But it keeps it interesting.
Indeed. And well, I think we are almost running out of time. So before wrapping this up, I wanted to ask you whether you have any final thoughts about what we discussed, about the future of finance or fintech, anything that you wanted to share as a final remark to our audience?
Yeah, I think this decade of the 2020s is going to be a very important one from the standpoint of the evolution of our world. And it's something that 2030, from the standpoint of the Sustainable Development Goals, from the standpoint of climate change, is not very far away. And the challenges of COVID over the past 2 years, the Ukraine conflict at the beginning of this year, all of these things make it even more difficult to hit those objectives. And I think it's very important for all of us to realize that we do have some of these big picture objectives that if we don't keep them in mind, if we don't manage to focus our energies on, that the consequences can be really even more dire than the consequences we've seen over the past couple of years.
I agree with you. Well, thank you very much, Douglas, for for having this discussion with me, for coming to my show.
Thanks very much, Royal. Really thanks for the invitation, and enjoyed the discussion. Look forward to the next time.
Well, it's been an absolute honor, an absolute pleasure, and well, to all my listeners, thank you very much for listening to this episode, and please stay tuned for the next ones. Bye.